Pfizer, stock ticker PFE, issued a massive warning, cutting their outlook for fiscal year of 2023. Pfizer now said they expect their revenue target to be in range of 58 to 61 billion compared to a previous outlook of almost $9 billion more. They also cut their adjusted EPS target to be in the range of 145 to 165 as compared to the previous outlook of 325 to 345. So a pretty severe cut, I would say. And if you look closer at what the stock market said, you can actually see here, it went pretty down south pretty quickly. The day after, it jumped back up again. But if you zoom out year to date, they are still down 35%. Zooming out 1 year, almost down 24%. Comparing that to an S&P 500, you can see here year to date, S&P 500 up around 14%, down 35%. Zoom out 1 year, and then still up around 19% compared to minus 24%. So even with all the money that came into Pfizer during COVID, the stock still hasn't really been able to rally ever since. And if you take a look at some of the dividend stats here, it offers a pretty hefty dividend of 5.11%, annual payout ratio of 164. Payout ratio sits pretty nicely at around 30%, 5% growth rate, which is also pretty good, and a 12-year growth rate. And if you go into the dividend history, you can see here over the last 10 years, steadily increasing a dividend. As you can see, it actually paid out the same amount the last 4 times, so they are probably due for an increase pretty soon. Zooming out a little bit more, you can see they actually had a dividend cut back in just around the finance crisis. Ever since then, they've actually managed to raise it ever since. So that's also looking pretty good. But if you take a look at the finances, you can see here, because it tells a little bit of a more dim story, I would say. If you look at some of the numbers here, you can see they've actually grown the revenue quite a lot. Obviously, massive inflated by COVID here due to being a supplier of vaccine and also treatment. So if you just take a look at annual, it looks okay. They dropped around 25%, which is pretty okay, all things considered. But since this is for the last 12 months, if you go into the quarterly statements, you can see here that it actually looks a pretty worse, I would say, because we came off at 27, 22 and so on, and now we're down to around 12. So it's over half right now. And when this clocks in the last 12 months before the next couple of quarters, I think this will get pretty bad for Pfizer, even worse. I don't think there's too much downside from the current levels, but still, it's not looking too good. If you go into the cash flow statement, you can see net income also looking pretty good. They have obviously dropped as well ever since COVID. So if we again zoom into the quarter, this will look even worse. Coming down here to the cash from operations, which is what produces the free cash flow we want for the dividends, you can see it's actually still looking pretty okay. Yes, they had some pretty high numbers here, but then we go back to 2018 and so on, and it looks pretty okay. I think they will find their foothold again and be able to grow in the future at some point. And also the capital expenditures haven't increased that much. A slight up here, but again, it's not too alarming, I would say. They're producing a pretty hefty amount of free cash flow. But coming down to the free cash flow per share, you can find in the bottom, you can see it sits at 190. It obviously was way higher in the last couple of reports. But if you jump back into see here, that is 164. So indeed, still, it is not in danger at the current time, but there isn't that much more room right now to grow it. So I still believe that Pfizer would need to reinvent their pipeline to be a really good stock in the future. And if you take a look at what Wall Street analysts think, they still have it rated as a buy. And just as we saw with the last video I made of Kraft Heinz, there's a lot of analysts that still has it as a strong buy or buy, with a majority having it as a hold. And I think this probably is the correct one as well. And coming down here to what the analysts think, they actually have it as a 30% upside from the current levels with a $42 price target. But to calculate the intrinsic value, we obviously also want to do that ourselves. So we jump into our stock screener, zoom in a little bit so we can see everything a little bit better. So right now, current price around $33. The PE ratio sits around 10 right now, which is below the 5-year average, so pretty okay looking at the current time. The revenue over the last 5 years has grown a lot, again, boosted a little bit by COVID, so this is really interesting to see how this will look into the future. We're pretty close to the 52-week low, though. The net debt to EBITDA sits way below 1, which is pretty good. This is an extremely nice statistic, I would say, and return on invested capital, return on equity is also looking really good, above the 5-year averages. We have seen the analyst target price before, very low short interest, which is also really good. And then we come to some of the margins, also looking pretty good. They have actually increased the operating margin, which is something I really like to see, and still have a pretty nice operating margin and profit margin coming out of them. And jumping a little bit into a dividend data tab, you can see here, what we really want to see here is some steady growth. And you can see it has tapered off a little bit the last couple of years, down to 2.5% roughly. and the 10-year growth rate sits around 5%. So really want to see this go back up again. I expect a very small increase the next time, probably around this 2.5% again, to be honest. Coming down to the dividend yield theory graphs, at least here, according to dividend yield theory, there's a massive discount of 22% to be had at the current time. You can see here on the right, whenever we move up into the blue area, which we're way above the average yield, then obviously it could be a potentially good buy, at least according to the dividend yield theory. And to support that, we do have a lot of other valuation models. So let's jump into them. I don't want to go into the details of every single one. For the discount cash flow model, I think I will exclude this one because these numbers skewed a little bit. But you can see here, if we do make a very conservative growth rate of, let's say, 5%, maybe that's a little bit better going forward. We also have the dividend discount model, the multiples valuation, the Graham's revised valuation model, PE model, free cash flow valuation, and the Peter Lynch model. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Now let's jump into the summary where we do have all our valuation methods. Some of them are negative. For example, the Peter Lynch model was negative and it doesn't just import the number here. Graham's also negative, so we will be excluding those two. Since we lowered the discounted cash flow model to a pretty conservative growth, I think this is pretty fine to keep it. So let's keep all of these. The average intrinsic of those becomes around $50. With the current price being $33, this actually could be a potential 34% upside from the current time. But obviously we do want to include a bit of margin of safety. And as always, we do have our calculator over on the right. So it takes a standard of 25. And then depending on some of the key metrics, as we saw in the stock screener, it either adds or deducts a little bit of margin of safety. And in this case, actually, because some of the key metrics are so good, it actually says that margin of safety 0, at least according to some of the numbers and the key metrics here, it should be perfectly fine without adding a margin of safety. There should be plenty of margin of safety built into the model already, which puts the acceptable buy price at $50, or at least the intrinsic value to be at $50. So potentially a really good buy at the current time. Even if we put in a just higher, just because we would like to have it 10%, then still $45. But am I a buyer of Pfizer at the current levels? And no, I'm not. I do believe the whole rating is probably the correct one. The company will return a lot of the treatment courses and have a big inventory write-off of those. They have a big annual savings program that will take some years to be fully implemented to lower the cost into the future. I don't think Pfizer has a lot of downside from here, but I don't think that it will rally in the near future either. It needs to get a little bit more away from the COVID shakeout ever since those days are over and that gravy train has gone by the station. So let me know down in the comments if you are a buyer of Pfizer at the current levels, and I'll be seeing you in the next video. Thank you for watching.